What's up? Today we'll be taking a look at some of the best healthcare ETFs on the market. I struggled for a while as to how to organize this video, as the healthcare sector is very large with several subsectors that can be very different from each other. I decided to group the ETFs into the following categories: broad healthcare ETFs, biotechnology, medical devices, healthcare providers, and pharmaceuticals. Granted, we'll spend most of the time on the broad healthcare ETFs, the biotech ETFs, and the medical device ETFs, as I find them the most interesting. And which subsector you choose to invest in really depends on your goals as an investor. Of course, the broad healthcare ETFs will give you a mix of everything. The biotech ETFs can be really the speculative high flyers on the list, particularly if they are small caps. The medical device arena is kind of the tech sector of the healthcare sector for those that like tech. The healthcare providers can be a type of secular growth, and the pharmaceuticals are more value dividend payers. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, feel free to lurk below and check out the links in the description. You can get free stocks, free crypto, cash back on purchases, and other fun stuff. So without further ado, let's get started. Just to start with a quick definition, the healthcare sector includes companies that sell drugs, medical devices, and insurance, as well as hospitals and healthcare providers. The healthcare sector accounted for 18% of U.S. GDP in 2020. The aging U.S. population, particularly the baby boomer generation, continues to drive demand in the healthcare sector. Demand in healthcare tends to be price inelastic. The sector can be subject to the whims of political talking points, but one thing's for sure, the industry certainly isn't going away anytime soon. Let's get into the ETFs, and first with that, the broad healthcare ETFs. I have picked 4 of them to examine, as each ETF offers something that the others do not. XLV by State Street Global Advisors is the most famous OG healthcare ETF. It is really used as the benchmark to define how the healthcare industry is doing as a whole. Next, I have FHLC by Fidelity. This ETF can really be used interchangeably with the larger and more well-known VHT by Vanguard. They track the same index, both are well managed, and thus they tend to end up being mostly identical. The only reason I chose to show FHLC over VHT is the expense ratio, this being the annual cost of management. It is 2 basis points cheaper than VHT. Granted, both of these have excellent expense ratios. If I held VHT in a taxable account, I wouldn't exactly panic sell my VHT for FHLC over a 2 basis point cost difference. It is really not worth the tax hit over such a small change in cost. Next on the list is IXJ by Blackrock. While the expense ratio is not as cheap as the others, it's on the list because it's the only ETF that has global exposure instead of just exposure to US equities. Last on the list is PSCH by Invesco. This one made the list because while it provides broad exposure across the healthcare sector like the others do, it is mostly focused on small caps. So let's take a quick look at regional exposure. Again, IXJ is the only one on our list with international exposure. 70% of IXJ are US equities, 20% are European, and 6% are Asian. The US markets have historically outperformed international markets, but that could change at any time. It just depends on if you value the added diversification that you get from owning international equities. Some would rather keep their money in US equities because, well, America. So let's take a look at the market cap structure for all these ETFs. This is where we see the most significant differences between XLV and FHLC. While XLV and FHLC have nearly identical top 10 holdings, FHLC has significantly more holdings than XLV, almost 500 compared to 65. With these ETFs being market cap weighted, XLV ends up having a higher percentage of large caps at 90% compared to the 75% in FHLC. IXJ also has a similar percentage of large caps at 90%. Again, PSCH is the most different on this list because it's composed almost entirely of small and micro cap stocks. Small cap stocks have historically outperformed large caps over time. However, while they can provide greater opportunities for growth, they tend to be riskier and more volatile. While large caps are often seen as more transparent, more stable, more consistent, with larger resources to better withstand tough times. But of course, these are generalizations. Large is not always safe, small is not always risky. So moving on to industry exposure, again, the point of the broad healthcare ETFs is to have a little bit of everything in the healthcare industry. For that reason, I won't spend much time on this, but it looks like IXJ is the biggest play on pharmaceuticals and PSCH has the smallest percentage of pharmaceuticals. So moving on to top 10 holdings. Again, the top 10 holdings of XLV and FHLC are pretty much identical. We see well-known names such as United Healthcare, J&J, Pfizer, Thermo Fisher, and Abbott. Admittedly, I know nothing about any healthcare company outside of the US, but most people won't recognize the small cap names in the top 10 of PSCH. I think we can say that XLV is the least diversified as it has the least holdings and the highest percentage in the top 10 names, While FHLC has the most holdings, it also has a higher percentage in the top 10 names than IHJ and PSCH. However, it can be tough to rank diversification as it depends on so many factors, such as number of holdings, weighting of holdings, geographic composition, market capitalization, and industry exposure. So let's take a look at the expense ratios. XLV charges 12 basis points, FHLC charges 8 basis points, IHJ charges 43 basis points, and PSCH charges 29 basis points. This means that on a $10,000 investment, these ETFs would charge $12, $8, $43, and $29 annually, respectively. 8 basis points is very good, borderline dirt cheap. This is getting close to the 3 or 4 basis point expense ratios that we see from some S&P 500 ETF issuers. Granted, obviously these track different indices. 0.43%, while not terrible, is definitely getting up there in cost. It may not sound like much, but small differences in costs can compound to become large differences over time. I always love showing this calculator because it illustrates this concept. If you invest $6,000 a year into 2 ETFs, one with an 8 basis point expense ratio and the other one with a 43 basis point expense ratio, assuming equal returns of 8% a year, over 40 years, the 43 basis point ETF would cost you $133,000 more. So you could buy a Tesla Model S Plaid with those cost savings. But again, this assumes equal returns, which would never happen between 2 ETFs that track different indices. And the more expensive ETF could outperform. So while we do need to be careful to not step over dollars to pick up pennies, we also need to be humble enough to recognize that the cost side of the equation is the only thing that we can control. We know what they will cost, but we don't know how they will perform. So I'm going to skip over spread costs and tracking differences as we still have other ETFs to get to. So let's move on to performance. For this, I'm going to look at VHT instead of FHLC as it shows us an average 10-year return because it's older. Again, these ETFs track the very same index and therefore they have nearly identical returns. But I will point out that VHT has slightly outperformed FHLC over time. IXJ has lagged the other ETFs, averaging around 14% annually over 5 and 10 years. Possibly the international equities holding it back over that time. VHT and FHLC slightly outperformed XLV, averaging around 17% over 5 and 10 years, but PSCH wins on performance, averaging around 19%, both 5 and 10 years, thus confirming that the small cap healthcare outperformed the large caps over this time. But if you look at the PSCH graph, small caps have been getting absolutely crushed recently. It really is the market having a recent aversion to risk-on assets. So while PSCH won on long-term performance, the recent activity gives you an idea of the kind of volatility that you can experience by holding small-cap stocks. So let's take a look at dividends. The trailing 12-month dividend yield for each is as follows. 1.35% for XLV, 1.19% for FHLC, 1.19% for IXJ, and nothing for PSCH. So what are my thoughts on the broad healthcare ETFs? I would say I like FHLC the best. It is low cost, liquid, diverse across the healthcare space, and has more holdings and more exposure to smaller caps than XLV does. I personally don't value the international exposure that IXJ provides, though I see why some would. I wouldn't want to pay a higher expense ratio for it. I will admit I am kind of a cheapskate on this. I love a good low expense ratio. It just makes me feel good. But I certainly see the draw of holding small cap names in PSCH. I also like that PSCH also holds a high percentage of medical device companies and a smaller amount of pharmaceuticals. Sure, there's a lot of volatility with the small caps in PSCH, but it could certainly be worth it as a long-term hold. Alright, let's move on to the medical device ETFs. Tech and growth investors tend to be right at home in this subsector. These are the kind of companies that make pacemakers, insulin pumps, operating room monitors, defibrillators, surgical instruments, etc. The best med tech companies are very innovative and invest much of their time and effort into research and development. Companies with patented products can gain considerable market share. The inelastic demand for these products tends to create solid profit margins. And because these products are non-discretionary, these companies can maintain steady revenues at all stages of the economic cycle. We see this kind of consistency in the charts too. For example, you might be able to delay buying a TV until the prices get lower or the economy gets better, but you can't delay treating a medical emergency. So we'll be looking at 2 medical device ETFs. First up is IHI, the US Medical Device ETF by Blackrock. I usually save my opinion for the end, but I can't contain my enthusiasm, so I'm just going to say it. This is my favorite ETF on the list. This ETF has delivered very good and very consistent returns over a very long time period. The expense ratio is not my favorite, but anyone that has owned this ETF over the last 10 years probably isn't complaining about it. The other medtech ETF we will look at is XHE, the S&P Healthcare Equipment ETF by State Street Global Advisors. I chose this ETF for our comparison because it is a small cap alternative to IHI, which tends to be more large cap. So let's start with market cap exposure, because both of these ETFs are all US equities. Well, actually, XHE has 1.5% European exposure. IHI is 75% large cap and 20% mid cap. XHE is 35% micro cap, 30% small cap, and 20% mid cap. So again, the debate becomes large versus small cap. But just as a friendly reminder, it doesn't have to be one or the other. We are allowed to own both. Maybe the investor would like some small cap exposure in the space, but is not willing to put all their medtech exposure into the small caps and therefore would own a blend of both. No sense in looking at industry exposure, as we already know what the subsector industry is. These ETFs are inherently non-diversified as they focus on companies in a very specific market. So let's look at top 10 holdings. Both of these ETFs have a similar amount of holdings, 70 to 80, but IHI has a very high percentage in the top 10 names, 71% compared to the 16% of XHE. Some would argue that this is a concentration risk, but at the same time, others might argue that these are long-standing large cap companies and are still more stable than holding the small caps in XHE. Most of us will recognize the top 10 names of IHI, Thermo Fisher, Abbott, Danaher, Medtronic, etc., but many people won't recognize the many smaller cap names in XHE. So moving on to costs, both of these ETFs have expense ratios in the same ballpark, 41 basis points for IHI and 35 basis points for XHE. So we give the cost win to XHE. Neither of these expense ratios are fantastic, but not terrible. I think they're fair for them being specialty ETFs. Anyone that buys the ETFs is banking on outperformance that will more than make up for the higher costs, and over time they have performed well. So let's take a look at that performance. Over 5 years, IHI has averaged a 24% return and XHE has averaged a 19% return. Over 10 years, IHI averaged a 22% return and XHE averaged a 19% return. So we give the long-term performance win to IHI, but both of these show great returns and both have outperformed the broad market over that time. Granted, they assume more risk than the broader market, but to put it into perspective, Warren Buffett has averaged an annual return of about 20%. So if you invest $500 a month for 40 years and average 22% a year, after 40 years you would have $77 million. Obviously this would never happen, but a man can dream. Getting this kind of returns over such a long time period is near impossible, and typically people de-risk as they get up in age, thus lowering the expected returns. But it does give you an idea of the power of compound interest and just how well this ETF has done. And when we look at the 5-year chart for IHI, it is very steady, just good consistent growth. XHE, being small cap, is a bit more of a wild ride, but as far as dividends go, being that these are largely growth ETFs, we don't really buy them for the dividend, but IHI is currently paying 0.44% and XHE is currently paying nothing. Moving on to the biotech ETFs, at its simplest definition, biotechnology is technology based on biology. Biotechnology is technology that utilizes biological systems, living organisms, etc. to develop or create different products. It's a very innovative and forward-looking sector, but investing in it can be very high risk, high reward. A breakthrough technology can provide investors with life-changing returns, but with that comes the risk that a company's promised technology will never make it to market and the price could tank. Additionally, biotech companies face uncertainty from regulations. The sector is very complex and technical, making it hard for the average Joe to pick the winners. For that reason, many investors will choose to gain biotech exposure through ETFs, because while we may not be biotechnologically literate enough to pick the winners, we can still see the value in the space as a whole. The idea being that the winners of the ETFs should be enough to make up for the losers. But buying a biotech ETF doesn't necessarily shield you from the volatility. This sector is known for being a bit speculative, high-flying, and volatile, but those that have long-term conviction can potentially be well rewarded. Okay, so we have IBB by Blackrock, BBH by VanEck, and ARKG by ARK Invest. Also, a side note, I stumbled across IBBQ by Invesco when I searched for IBB. This is a new ETF that tracks the same index as the IBB, but it has a notably lower expense ratio than the IBB. Absolute savage move by Invesco, making the same ETF as Blackrock, undercutting the price and literally only adding a Q to the end of the ticker name. But we'll talk more on this later. IBB and BBH are comparable in terms of market cap exposure, but IBB has significantly more holdings. ARKG, on the other hand, is actively managed by famous fund manager Cathie Wood. ARK Invest specializes in investing in disruptive innovation and aims to deliver outsized growth as industries transform among the innovation platforms. ARKG specializes in biotechnology and genomics. It provides exposure to DNA sequencing technology, gene editing, CRISPR, therapeutics, agricultural biology, and molecular diagnostics. I just want to reiterate that it is actively managed. While the team at ARK Invest is very much research focused, very specialized, and much more technologically literate than most legacy active managers, the long-term statistics on active management are grim. Most active managers fail to outperform passive benchmarks over a long period of time. Additionally, active management comes with increased management fees and also more trading costs and more tax inefficiencies that come from that frequent active trading. So active management usually means more portfolio turnover and more short-term capital gains. But against all those odds, some active managers can make it worthwhile. Moving on to regional exposure, these ETFs have mostly US exposure at around 90%, with some of the rest being European exposure. Looking at market cap exposure, IBB is relatively diversified across market cap, BBH is all large cap and mid cap, and ARKG is notably different with more focus on small caps. Moving on to industry exposure, I would say IBB and BBH are more of a pure biotech play than ARKG. ARKG has some exposure to some additional innovative healthcare themes, but is still very much in line with the spirit of biotech. Looking at top 10 holdings, we see much similarity between IBB and BBH. Both have Moderna, Amgen, Regeneron, and Illumina in similar percentages. However, the big difference is that IBB has nearly 300 holdings and BBH only has around 25. The smaller cap names in ARKG are less well known and tend to move around a bit, but Kathy Wood is well known for being a big fan of Teladoc. It is usually way up there in the top 10 of ARKG. So let's move on to cost. The annual expense ratios are as follows: 45 basis points for IBB, 35 for BBH, 75 for the actively managed ARKG, but 19 basis points for IBBQ. It says 0 because there is currently a fee waiver on this ETF until at least December 17, 2021. As I mentioned earlier, this is a new ETF from Invesco that tracks the same index as IBB. ETF issuers will often have a temporary fee waiver to attract new investors to invest in their ETF. While this ETF is cheaper than IBB, it does have higher spread costs. Spread is the measure of liquidity and the cost of trading shares, essentially the difference between the bid and the ask price. If the ETF is popular and trades with robust volume, then bid-ask spreads tend to be narrower, but if the ETF is thinly traded, or if the underlying securities of the fund are highly illiquid, that can also lead to wider spreads. Because IBBQ is so new, it's still smaller and much less traded, therefore it has higher spread costs. A trader frequently moving large amounts of shares may prefer to stick with the more liquid IBB, but a long-term buy and hold investor may take the cheaper IBBQ. The 75 basis points that ARKG charges is definitely a high expense ratio compared to the passive alternatives, but compared to typical active management costs, it is not terrible. I would say fair, but it comes down to whether or not you value the active management. If you do, it may be worth it. If you don't, then maybe a passively managed alternative would be better. So let's look at performance. IBB is the only one that has been around for 10 years. During that time frame, it has averaged 16%. That is similar to what the broader market has done. Looking at average 5-year return, we have 10% for IBB, 12% for BBH, and a whopping 30% for ARKG. Granted, the vast majority of that return came in 2020, and ARKG has been absolutely bleeding in 2021. Again, biotech is a very high-flying speculative market, and ARKG is filled with smaller cap stocks. The small cap stocks just add to the volatility. The market has been very risk-off recently. Small cap biotech stocks are very much risk-on assets. When the market has appetite for risk, the returns can be incredible. When the market becomes risk-averse, risk-on assets can experience big sell-offs. It's up to you as an investor to decide if you believe in the long-term story of the biotech sector enough to stomach the volatility. Investors tend to be emotional and buy when prices are going up and panic sell when they go down. Like our buddy Warren Buffett says, be greedy when others are fearful. Be fearful when others are greedy. Could this be a good long-term entrance point? Possibly, but it's also possible that prices just keep on dropping. So what are my thoughts? I'm a fan of the healthcare sector as a whole. It has been the third best performing sector over the last decade. However, I don't currently own any of the broad healthcare ETFs. Like I mentioned earlier, the healthcare sector is filled with many different subsectors with different dynamics. Conventional wisdom tells us to diversify between growth and value, but I tend to lean a bit more towards tech and growth. So I personally may be less attracted to the value plays such as the pharmaceuticals, and I may tend to gravitate more towards the tech and growth vibes of the medical device industry. For that reason, I have skipped the broad market healthcare ETFs and have chosen to invest in the subsector ETFs that most interest me. However, if I had to pick a broad market healthcare ETF, I would pick FHLC. As I said earlier, it's low cost, liquid, well managed, and well diversified across the sector. As far as the medical device ETFs, I basically mentioned that I own some IHI. This ETF is filled with quality, consistent, large cap medical device companies. I like the innovative nature of the subsector and the work that it does. The performance of IHI has been solid and steady over such a long time frame. Obviously, it's no guarantee of future results, but it certainly gives us an idea. And I don't foresee demand slowing down anytime soon. As far as the biotech ETFs, I have been bag holding ARKG this year. It was my best performing ETF in 2020 and my worst performing ETF in 2021. I think this industry will bring some amazing life-changing technologies to market over the next 10 years. For me, it really is a long-term play, and I do want some exposure to it, but not so much that I can't sleep at night because of the volatility. I do like the team at ARKG, but I would like to have some of my biotech exposure in something that is more low cost. 75 basis points is a lot. For that reason, I may open up a small position in IBBQ. IBBQ would also provide some more large cap biotech exposure to round out the small caps that ARKG holds. Also, as an off-topic side note, when Invesco made IBBQ, it also made SOXQ, a lower-cost copy of the famous semiconductor ETF SOXX. I previously made a video on semiconductor ETFs that you can check out on my channel, so I might be buying me some SOXQ. But if you found this helpful, consider hitting the like button and subscribe for more content like this. Again, consider checking out the links down below. Currently, down there you can get 2 free stocks of Webull, potentially valued up to $2,300, $30 with M1 Finance, $50 of Bitcoin with Celsius, where you can earn interest on your crypto holdings, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial advice, just entertainment purposes only. So thanks, and I'll see you in the next video.